Welcome to Thimbleberry U. I'm Michelle Odell, and we are again with Amy Walls talking about financial planning and asset management. Amy, how you doing?
I'm doing great. I'm excited for our topic today.
This is one for a lot of people who are interested in buying a house. So this episode is thinking through a new mortgage in a higher interest rate environment. More than likely, our listeners have experienced inflation and noticed higher interest rates because it's all over the news. Can you talk about what these mean when it comes to getting a new mortgage?
Let me start with a little background. I've been an advisor coming up shortly for almost 20 years. And it's only been recently that I've been able to address interest rates as anything but low. Therefore, it's been a long time since people experienced getting a mortgage at a rate above 5%, and even longer since they were above 6%.
Exactly.
Recently, I reviewed mortgage options for a client looking to buy a new home at 5.5% for a 15-year loan and 6.5% for a 30-year loan. That's a drastic difference from a year and a half, 2 years ago at, less than 3%. And so I think it really requires a different approach. The problem is it's hard to recognize it requires a different approach when we've had these very low interest rates for the last 20 years. Mm-hmm. So I should also mention inflation since you touched on that. We all know that our money isn't going as far at the grocery store or if we go to do some, fun renovation to our house. And so with that, higher interest rates also mean our money isn't going as far. So this can be a double whammy when you're looking at buying a new home in this environment.
Can you talk about what is different then in this situation?
It's going to be the approach. But let me start with financial planning. At least how we look at it is all about our clients getting what they want from their lives. What works for one person isn't necessarily right for the next person. The differences are goals, it's their values, it's their approach to life, and that includes risk. The easiest way to talk about this, I think, is to compare two people. Mm-hmm. So first, let me explain some similarities between them. Let's say that both are in their early 40s and they're purchasing their second home. They're not planning to keep their first home, but they've got the resources to buy a second home, and then they're going to sell their first home. They have plenty of money saved for a down payment, and they can absolutely cover the cash flow from floating both homes for a little bit. So now let's start with some differences. I'm going to call one of these people Jane Doe, and Jane is an aggressive investor. She feels very comfortable with market fluctuations and the predictability of future income and the ability to save. Okay, Jane doesn't accumulate debt, but also doesn't worry about getting loans paid off quickly. So for example, car loans and the mortgage for the home that Jane already owns hasn't paid them down faster. Okay, but let's contrast that with John Smith, who had many similarities to Jane Doe. But in this case, John is a moderate investor. John feels okay about market fluctuations, but doesn't like debt. This really makes John uncomfortable and will apply extra cash flow to any debt rather than investing that. Okay, so rather than saving it in savings accounts. Actually, though, does like having a cash reserve.
Sure.
But John always feels a little bit uncertain about future income being there at the same level.
Okay.
So in this scenario, they both have decisions to make. They have a decision to make about the kind of mortgage they get. Is it a 30-year mortgage? Is it a 15-year mortgage? Do they get an ARM? Okay, I haven't talked about ARMs in a long time, but an adjustable rate mortgage, an ARM, yes, which can be maybe a 5-year ARM or a 10-year ARM where the rate will be locked for that period of time, and then it will be flexible in terms of the rate, and it will still have an endpoint. So another thing that they need to consider and make a decision on is if they're going to pay points on the mortgage. Points are how you buy down a rate. So basically you're paying more to the mortgage broker, mortgage company, to buy that rate down. And they have to make a decision about how much money to put down on this new home. So in this example, Jane being more aggressive and very comfortable with cash flow and not feeling driven to pay down debt really quickly may be a great candidate for a 15 or 30-year loan because we can expect her to carry that loan to term. And buying down the rate by paying points may be a great solution for her because she's going to have this mortgage for a very long time. So having that lower interest rate makes a lot of sense.
Sure, yes.
May make a lot of sense, I should say.
Right.
So John, on the other hand, may be comfortable with the 15-year loan, may also be comfortable with a shorter adjustable rate loan and not paying points because John is likely to pay this loan off as quickly as possible. He may be able to do so in 4 years, especially after selling the first home, while still saving for retirement. So paying points in this case would be extra cost that John doesn't need to incur, even though it would result in a lower rate that feels good. That lower rate for the short period of time doesn't offset necessarily the cost that's going to get paid.
Exactly.
So John also should probably put down as much as he's comfortable with in his down payment because his goal is going to actually be to get rid of the mortgage as soon as possible.
So he doesn't need to pay points. He doesn't have to think about the long term because he's probably going to have this taken care of in the next 4 years. That's a very interesting example. How does someone think through buying and selling in this environment then?
Yeah. Have you ever heard the expression, Michelle, marry the house, date the rate?
I have heard that. It didn't make sense at first, but lately it totally makes sense now that the interest rates have gone up.
Yeah, it definitely puts a different perspective on it. So rates are expected to change. Right? We're recording this in early 2023, and the projections are that rates go up for a little while, and towards the end of 2023, they'll be lower than where they are now. So with them changing, you hope to end up with a rate that you love and that lasts, right? Mm-hmm. You want both. But a rate isn't necessarily forever. You might change homes. You might refinance, for whatever reason. And so the rate is not permanent. So that's date the rate. Marry the house is the house you buy should be a place ideally that you're going to be comfortable being in, hopefully forever, right? Because you're marrying it. And now we have to acknowledge that circumstances change. There might be a reason to move, that sort of thing. You don't want to be buying a home that you're thinking of only being in for a short period of time.
Right.
It's also, I think, important that we recognize our biases. The rates we've seen in housing over the last number of years do create bias. And so it can seem unrealistic to buy a house at today's interest rates, which are still much lower than they've been historically.
Sure.
But just much more than what we've had in the recent past. So that bias can put a spin on our feelings. And with time, we will adjust. But we've got that recency bias playing in our minds that this is just not a good situation. We shouldn't do it. But if you're marrying the house, there's a good reason. You can date the rate as long as you also know you can afford it all.
Right. Now, should people be cautious about rates and prices?
I think it's always something to consider. So yes, as we started this, with higher rates, money doesn't stretch quite as far. That can mean that prices will come down somewhat. It's hard to say how much that will be. I mean, I wish I had a crystal ball or a magic 8-ball, but I don't. So they could come down. We've definitely seen some slowing in the housing market. Things just aren't moving as quickly. It also seems like potentially sellers aren't ready to accept that prices are coming down, and buyers, because of higher rates, probably aren't willing to accept the higher prices. And so things sit. So ultimately, though, if the buyers are eager to sell, those prices will start to come down. And I think that's something important to think about when we think about how much money to put down in our example with John and Jane, right?
Right.
If prices are coming down and you only put 5% down, well, there's a reason that lenders actually want you to have 20% down. You may end up in a situation, if you don't put enough down, that in a year you're underwater in your home, meaning you owe more on it than what it could be sold for. So It's worth paying attention to. And so I think with that said, stick with the idea of marrying the house, making good, sound financial decisions. Don't take on more debt than you can. Don't take on payments that are bigger than you can. Have a backup plan. And if you keep that long-term view, hope for the best and plan for the worst, things tend to work out.
Absolutely. And that goes for a lot of things, actually, when you think about it. I'm sure people, if they have any questions, they want to know more about this topic, interest rates in general, questions they may have for you, what's the best way to get a hold of you, Amy?
Yes, they can give us a call at 503-610-6510 or find us online at thimbleberryfinancial.com.
Okay, well, in the meantime, have a great couple weeks and we'll talk to you very soon.
Sounds good, Michelle. Thanks.
Registered representative securities offered through Cambridge Research, Inc., a broker-dealer. Member FNIRA, SIPC. Investment advisor representative, Cambridge Investment Research Advisors, Inc., a registered investment advisor. Cambridge and Thimbleberry Financial are not affiliated.